Welcome to Stop the Noise, where small business specialists cut through the clutter to hone in on practical things small business owners can do to solve business challenges and move their business forward. In today's episode of Stop the Noise, host Brenda Thompson from the Better Business for Good Company and Martin Katak from Finance for Business are talking with Maria Coleman from Morella Tyson and Ian Harris from B&I Lockwood Accounting about tax planning. You'll walk away with an executable checklist of 10 questions you need to ask yourself and discuss with your accountant to ensure you minimise and manage your foreseeable tax obligations and utilise available tax concessions. And I saw a post on LinkedIn this morning that described end of financial year for business owners as like looking at a raging bull running towards you and having absolutely nowhere to go. So we are at that time of the year. So we've got some really great questions about tax planning and facing end of financial year. So I might start with you, Ian, if I can start with you. And the first question we've got here is, why do tax planning? What are the objectives? Why do we bother?
Well, we don't want the raging bull coming at us. That'll be the first thing. It'll be good to see him going, but we don't want him coming at us. And that's basically the raging bull is actually quite a good parallel, really, because tax is just like any other business expense, and so it sticks into financial management like any other expense does, except it's done with a different authority, which is the government. And so most of the other stuff is rent and wages and all that sort of stuff, they're small transactions, etc. But tax is your compliance stuff. And so what you're trying to do, when you look at BHP's profit and loss account, you'll see all the expenses minus tax, right, is the profit. And so tax is a critical part of the profit. And if you don't plan it, you're probably knackered. And so the idea is that the objective of tax planning is to increase your after-tax income. That's the whole point. And so you'll often hear, over the years, I've heard people say, I don't like paying tax. I don't want to pay any tax at all. Right? And you say, well, you like making profits. Oh, yeah, I like making profits. Yeah, okay, well, it's part of that exercise of just planning. And to not pay tax, that either means, one, you may not have any profit, or alternatively, you've spent all your money on assets which are just there to wipe out your tax bill. And that may not be good decision making. In fact, it probably is not good decision making.
No.
So increasing your after-tax income is the prime goal of tax planning. And the other side of it is, well, of course, cash flow is important these days, isn't it? All right. So in the old days, it was simple. You had provisional tax, and you used to plan to pay it, and you knew when you were going to pay it thereafter. Well, all that 20 years ago changed the new tax system, and it's called pay as you go. So you need to be taking into account the cash flows, as Martin will tell you, that the cash flows are very important for actually banks, etc., and the viability of the business. Because it may be you've got, if you don't plan it properly, it may be you've got a tax bill you just can't jump over. So you need to understand, and also as part of that is the planning of cash flow is a critical discussion and conversation with your bank, because that's where probably you're going to get some of these funds from sometimes if you're getting a corner. So the improvement of cash flow basically revolves around deferring tax payments. So there are ways that it can be deferred into the next year, the next quarter, and next whatever else it is, and also minimising the tax. And I shared with Maria Kerry Packer's famous talk to the Senate Select Committee some years ago, when I think Ian Sinclair was on the Senate Select Committee, and Peter Costello was on it, and he basically Packer laid into them and said, if you don't minimise your tax, you want your head read, because you blokes not doing good enough in managing the funds of this country that I want to pay you more. Right, so this is part of the exercise, is minimising the tax.
Yeah.
that you can get by.
Fantastic.
So financial
Yep.
management. So it's
Yeah,
just financial management.
Yeah, so it's just managed. Really, it's another expense that needs to be factored into the whole financial management of your business.
Absolutely, it is.
Absolutely. Did you want to add anything to that, Maria, or did you, Martin?
I think Ian covered it really well. It's about making sure that you pay as little tax as possible,
Legally.
which is what Ian's basically said.
Absolutely.
And perhaps I'd like to say that the contrast is that while one tries to reduce the bottom line to pay a minimal of tax, it can be a disadvantage when one wants to leverage the company and borrow money because there's nothing there. And so it's a fine line one has to walk through when you go to the bank and you want to acquire some funds, and if there's no tax paid because there's no profit shown, the banks are very reluctant to lend. So it's an awkward line to walk.
There could be I don't want to impugn tradies, but there could be a few tradies who do that, who do the kind of like the cash under the counter kind of thing. Yeah.
No, Brenda.
No.
Well, the government's actively trying to minimise people's ability to do that, actually. So people in the building industry have to report in another way the income that they're earning.
Right.
So they're trying to catch that.
That's right, and that is the other part. That is the other part of this planning stuff. So again, I go back, Brenda, and I hate saying this. In the old days, right, before the new tax system came in, planning was done at the end of the year, right? But now the government is getting information out of taxpayers all the time by way of their BAS, and by way of a range of other methods. And so it's the tax planning can't really be done at the end, right? It's got to be done all the way through at the beginning. Yeah,
which probably answered the next question, when you should do it. So it's not just something you do when the raging bull is running at you at the end of the financial year. It's something you do.
No, absolutely not. So the earlier you do tax planning, the better, and the more options you have available to you when it comes to the crunch. So the theory is that if you're setting up a new business, all right, the tax planning and the structures all need to be consistent for what will allow you to minimise your tax legally.
Right.
And,
so what are the steps
that you,
what are the steps you take in this process?
Well, there's a couple of ways of doing that. You just jump the gun there, Brenda.
Oh, have I? I thought I'd gone.
No. So there's two situations you find yourself in. Either you're starting a new business, in which case the structure of the business is quite critical to the outcome in terms of minimisation of tax. Or alternatively, you're already in business, and what you're doing is you're just keeping on sort of dealing with it as you go. So the way that I do it, if we go back to the normal thing, with here it is, we're in steady state, we're moving along. And so what happens is, normally what you're doing is you're looking at what a client has done thus far. All right. So the first question you ask is, okay, how have you gone for the year? And if you did nothing, what would be your tax bill? Right. So what that normally means is you probably do 3 quarters. So you do your up until the end of March with an estimate of the next 3 months. All right. And what that will do is it will bring forward some questions. Oh dear me, we're going to pay 100,000. We only paid 30,000 last year. Why is that? Oh, well, this is happening, this is happening, this is happening. Okay, well, what are the things that we could do? Okay, well, arrange, and we're going to talk about it later, a range of tax incentives that we could do. All right.
Would that be the kinds of things that are in the checklist that we're going to hand out later? The questions that were in that checklist?
Yes, that's right. Instant asset write-off as an example. If so there's one client I'm working with at the moment, and we've done the first bit. All right, and I've said, okay, this is what's going to happen if you do nothing. She's already flagged to me that there are a number of things that she might do. So there's some computers that need replacing. All right, there is some new premises that she's looking at. There may be some tax advantages in doing that. and so on and so on. There's a range of sort of little options that she's already got in her head. And the question is, can they contribute to reducing her tax?
Yeah. So that checklist that we've got, that everybody's got in their handouts, and that both of you, I think, have offered to sit down with people for an hour and actually work through those questions. That checklist would actually kind of be that process, yeah? Yes,
that's right. That's right.
Yeah. Yeah.
The thing is that in the beginning, the tax minimisation sort of works on the 5 basic principles of tax, which is reverting or channeling income to the person who's going to pay the least amount of tax on. Now, normally this involves trust, and the tax office know that. The tax office has already indicated, that they are concerned about the use of trusts in tax planning. But nonetheless, they are there. It is usually legal to use trust. But if it is that in a family business, as an example, that there is a couple of kids who are going to university, or there's a grandparent who is not on the pension for whatever reason, they can all receive income legitimately through a family trust structure. They might otherwise pay no tax at all. You can basically earn about 20 grand a year without paying tax. So to channel income to a student who's 18 is a good strategy. Of course, they've got to receive the income. They've actually got to.
Yeah.
They've got to
so there's a whole heap of strategies that really it comes down to. If you want to do this right, you need to go and talk to a Maria or an Ian.
Oh, yeah, that's right. That's right.
Absolutely, because there's no way that we can go into that degree of detail in this webinar. So I might. So if we kind of say that everybody's going to get that checklist, and we're going to make sure that everybody gets that, which is all of it was 10 questions that you should be asking yourself and then asking your accountant. So we might sort of move on from that with the assumption that anybody who wants to talk through that can either contact either of you or go to their own accountant. Perhaps if we move on to the tax incentives that are, Maria might throw this next one at you, unless you had something you wanted to add, Martin or Maria, if you had something you wanted to add to what Ian was saying.
I think as well, like, in addition to what Ian was saying, and it is in that checklist that you're giving them, and also in the slides, which gives a more detailed overview of how the tax planning process is done, to do it, as Ian said, as soon as possible so that you can put it in your forecast and budget, so there are no surprises when you have to pay your bills. And in budgeting, you can put the money aside for it. We often see clients who don't do this for whatever reason, and then they can get behind in paying their tax, and it's not something we want to encourage clients to do. So as well as making sure that we minimise tax as much as we possible, clients have to budget it and know it's part of what they have to pay throughout the year and when.
That's right. That's right. No shops. No shops.
Yes. So it's not something you just wait till the end of the financial year is looking at you and then go, oh my gosh, I need to send this stuff to my accountant.
That is the raging bull. You see, that is the raging bull. You've got nowhere to go. You've got nowhere to go. So in many cases, so there's another one is, by way of example, increasing the amount of deductions that you've got. Okay, so now this is a really good situation. So one possibility is an instant asset write-off. Right? But the asset has to be installed ready for use by the 30th of June. Right? There are supply chain problems out there.
Yeah.
Right. And in some cases, they cannot get the assets before the 30th of June. But if you were in a situation where you knew this was going to happen back in September, October last year, and one of the options was an instant asset write-off, as an example, right? Then you would have ordered back then, not now when you've got the pressure on you. So the longer you leave it, the more your options close off.
Yeah, and the more at risk you are of the raging bull getting you.
Yes, that's right.
Yeah, absolutely.
And so not only should you do tax planning at the start of the year, as Ian said, you should do it as soon as something unusual happens in your business. If your profits increase suddenly for whatever reasons, or they decrease, so that you can replan again, so that again, there are no surprises and you have a strategy in place. Or whenever you want, as I think Ian might have already said, whenever you want to buy or sell something for your business, discuss it with your accountant so the right entity can own it to maximise not only income tax deductions, but GST, other tax incentives that might be there for it. So
that checklist that everybody's received, it's almost you should talk to your accountant whenever any of these things is happened or is about to happen.
It's better to be planned, to have, I like people to be prepared and planned. I think Ian would agree. We hate being told after the fact. It's hard for us to put a good plan in place.
Sometimes we don't sleep, Brenda.
And I suspect that there's probably lots of businesses who just send their stuff to the accountant at the end of the financial year. That's possibly a long time after the end of the financial year.
That's right. In fact, the part of the art of running an accounting practice is teasing out the people who need tax planning. All right. So what you're often doing is actually going through the client list and having a look at them and saying, okay, how's that guy gone? How's that guy gone? I wonder how that's affected, this particular thing has affected that industry, and so on and so on. So that's part of the conversation with the client, is keeping up to date with them and seeing what's happened. And so I've got a guy up in Northern New South Wales, and he services the agriculture industry. And I'm often talking to him, just saying, how's it going? This time he said, yeah, look, despite what's happened up here, I've gone really well. And I have a look at him, and sure enough, $200,000 he's made. So he's worthy of some tax planning.
Yeah. So it's really that the ongoing conversation. Your relationship with your accountant shouldn't be a once a year thing. It should be an ongoing conversation, because that's whatever you're going to pay your accountant is going to come back in droves in terms of what you haven't, the opportunities you haven't thrown away.
Well, look, the economics of it's pretty riveting too, Brenda. You just think about it. If you can save 10 grand in tax and it costs you a couple $100 to talk to your accountant, returns pretty substantial. And it's just financial management after all. We're looking for leverage all the time, aren't we?
Yeah, absolutely. Yeah, Martin, did you want to ask any questions or add anything to that?
Well, I think the important thing that both parties have sort of mentioned, it's that relationship with the client, and tax planning should be something that everybody's talking about with their accountant all the time, as they should be about all their business issues. One of the things I constantly see is that small businesses do not get enough quality advice. They see their accountant as being someone to discuss tax with, but it should be a business discussion first, so then we can determine the profits and cash we're going to have, and then the tax discussion there follows. So Ian's example of the cost of talking to your accountant is incredibly good value, not only for tax saving, but also for business planning and business growth.
Yeah.
That's right. It is a business. That's right. It really is a business decision, business management. That's what it's all about. Really.
Yeah. And unless you are, as the business owner, unless you are an accountant and you do know all that stuff, and you've kept up to date with all the myriad of new things that fly across your desks every day, then you are missing out on that expertise. And I agree totally, Martin. You see so many businesses who don't get good advice, because they kind of go, it's like, advice costs money. I just need to stay in my cocoon and keep peddling. Like, good advice pays in dividends. Absolutely.
I would agree.
Well, and earlier conversations. That's the other thing. So Maria mentioned, often when you're buying something or selling something or doing whatever it is, there are some tax implications of it. I've got one at the moment where you've got where a lady is actually going to sell down some of her assets, and the timing of that. The timing of that is critical. She doesn't want to do it. There's no point in doing it this year, but because it'll come on, it'll be the capital gains this year, and it'll be taxed on top of whatever other income she's got. But if she sells it next year, I mean, we can plan around that. We can plan around that, and we can reduce their salaries and wages, income, do whatever we need to do to get the marginal rate down. But, you know, it's all about the conversation and what are you thinking going forward?
Yeah, yeah. So it's incorporating conversations with your accountant into your whole business planning process.
Absolutely. Yeah, look,
Yeah.
I'm going to
Okay.
do this. What's the impact
Yeah.
of that?
Okay. So what I thought we might do now is to move on to the questions we had for you, Maria, which were about tax incentives. So do you want to talk to the subject of tax incentives? And I know once again you've created a really lovely handout that covers all this, so people don't need to sit and scribble copious notes. The handout will come with the video, with the recording. So do you just want to talk through tax incentives, Maria? I think that would probably be really useful at this time of the year.
Yeah, well, there are many tax incentives in place, predominantly for small businesses. The government has been pretty generous for small businesses, and what they consider to be a small business to get some of these tax incentives at the moment ranges anywhere from a turnover of under 5 billion. The different incentives have a different turnover cutoff point. They also have very generous tax incentives for primary producers. I've got a couple of primary producer clients, and I've been able to see how the tax incentives have really helped them with their businesses, helped their decisions by using these incentives to invest in their business and in business assets, and so therefore grow overall the total value of their business. Ian touched on one of the main ones that is in place until the end of 30 June 2023, which is the 100% deduction for items of plant and equipment for your business. So, for example, cars, if you were to buy forklifts, you know, trucks, any item of plant and equipment that you need 100% deduction. If your turnover is over 50 million, you have to have, you can only, it has to be a new asset. There's also in place company loss carryback rules. So if you were to make a loss now for the 2022 year, 2023, you can carry that back to offset profits you might have made from 2019 onwards, if that makes sense.
I just want to explain that one. So if you made a profit but you haven't, then just do you want to explain that one?
So if you made the government brought it in with COVID to help businesses who might have had a profit, for example, in the 2020 year or 2019 year, but because of COVID, they found themselves in a loss situation. So what they've let you do is carry back the losses, generally with tax. Ian might have to give me some help if I'm not explaining it properly.
Right.
No, I'm starting to get
Usually you can carry forward losses and offset them against another year. Now they're letting you take them back.
So you have to amend your returns effectively. I mean, you go back and say, look, that I really didn't pay that much. I did pay this much tax there, but I made this loss here, so I'm taking this back so I don't have to pay this much tax in that year. Right. So it's moving it backwards and amending the return. Benefit of hindsight.
Is it an actual credit or a credit on paper that you?
No.
It's a credit you use in the current year.
Right. Yeah. Okay.
Yeah.
So it could actually mean a tax refund if you had a complete disaster.
Yeah, that's
absolutely,
right.
Yeah. Okay. Yeah. Cool. Now I get it. Yeah.
Yeah.
So you paid X hundreds of thousands of dollars worth of tax last year, and then this year, because COVID was complete catastrophe, and then you had a massive loss, so you can pull that tax back.
Yeah, you can pull back.
Tax office will give you money.
Refund of tax you paid previously. I know, it's all very
explained perfectly now. Yep, thanks, Maria.
Great. Company tax rates are going down to 25% for the 2022 year. There've been larger companies have to pay 30%, so that's really good if you're a small business entity. You've got to have, again, a turnover of less than 50 million to get that 25% tax rate. So Ian and I were discussing this week. It means effectively, if you're structured well, that should be the average rate of tax you should pay generally. If you're a business owner, you should be paying no more than that generally. We can get, there's also, if you're a small business, if you prepay expenses, you can get an immediate deduction. That is something that Ian talked about, something you might do if you're wanting to pay less tax this year instead of next year. So you can move it around a bit to help you to minimise your tax if it's better to do that this year rather than the next year. There are great incentives, as I said, for primary producers. They can get 100% tax deductions on all water, irrigation equipment, fencing and fodder storage assets. There are other, I'll wrap it up because there are many, but fuel tax credits are also available for businesses. If you've got trucks on the road that are greater than a 4-tonne truck, you can get a fuel tax credit that you can claim back on your BAS. If you also use fuel on your business premises for pumps or other equipment that you need to operate, you can get that fuel tax credit. So again, it's something that's very common with primary producers because they have a lot of equipment that they use on their property. There are great concessions in place for small businesses if they're selling some of their business assets or their business. So that's a really important one. It means that you can avoid paying any capital gains tax on any profits you've made on those capital assets that you've developed. So that's a really important one you need to see your accountant about because no one wants to pay capital gains tax, do they? So I think, would that be right, Ian? I've covered most of them.
Yeah, I think so.
There's also superannuation deductions. People can claim up to $27,500 for each person for superannuation. That can be a tax deduction. So I always think of that as it's a double bonus because not only do you get a tax deduction, but you've got the ability to put that money into savings, which is great for later on. So it's probably a discussion you should have with your accountant, but also with your financial advisor to see if that's where you should be putting any money you have to invest. There are also, I think, Brenda, there were some new tax incentives, which were the budget announcements. The government was going to allow small businesses to deduct an extra 20% on eligible training courses and also on the cost of digitising their business. That has not yet been passed. But I think, Brenda, I'll let you know that so you can put it out in your newsletter if that does get passed. So that's something that would be advantageous for people who supply IT services and or training services.
Training services, it would indeed, wouldn't it?
Because
yes.
it means that their clients will get that extra deduction. And those tax incentives, if they go through, are eligible until 30 June 23.
Right. So that's basically if somebody does, what defines an eligible things? Do we have other lists of that, or is that something you absolutely have to talk to your accountant about?
Well, I think so. We'll have to wait until the legislation is passed. They haven't done that. And with the change in government, I'm really hoping it does go through because I think we really do, as a country, need to encourage employers to train employees as much as they can.
It's for digitalisation as well of your business. So that is really important, that it gives a genuine tax incentive for digitalising the business.
Does that mean things, what's encompassed in digitising?
Oh, bringing in new systems that would allow you to automate a particular area or something like that.
Yeah, cyber security is on the list, cloud subscriptions to cloud-based services, business expenses and assets you use to for their digital adoption. So if you were to go paperless, for example, all the costs that you incur to do that. Portable payment devices were included in the initial scope.
Right. So that's some stuff there that would impact a lot of small businesses if they took advantage of those.
Yeah. But the legislation's not passed.
Yeah. That might be worth another webinar when it is to actually go through those, do you think?
It probably could be.
Yeah. It's pretty hard to argue against them, really. But if my way of thinking, probably the Labor Party would take those sorts of things up because they're actually trying to, get in good in the small business, I suspect. And to take that one away would be hurtful. Yeah.
Okay, is that now that you would have covered the new tax incentives in that question as well, then, Maria? So
yeah, I did.
So would it be a good time now to actually go through that checklist, which is all the things that, because we've got another sort of 20 minutes or so. Would it be a good idea to go to that checklist and actually talk to those items? I might just throw each checklist item out and you can both, sort of pick who wants to answer it and we can go from there.
Unless I did have a list as well of just other business and tax updates. Could we quickly run through that?
Yep. Good idea.
Ian said that trust distributions are being looked at more closely as well at the moment. So I'm sure everyone will find that they'll be discussing that more closely with their accountants now. Super guarantee payments for employees super guarantee is going to be payable at 10.5% from the 1st of July this year. So keep that in mind. It means the cost of employing staff will go up by that extra 0.5%. I did already tell you with Brenda, and I think it's been in your newsletter, that super is now payable on all wages, even if you're for lowly paid casual employees, unless they're under 18. So you've got to keep that in mind as well. Director IDs, I keep harping on about this, but everyone who is a director of a company has to have a director ID by November this year. So make sure if you're a director of either a trustee company or a director of your trustee company, of your SMSF or your business, please get a director ID. There are large penalties in place. There's also apprenticeship grants available until the 30th of June this year. They're really great if you want to take on an apprenticeship. I think they're worth about $28,000. Martin has previously told us about the government-backed loans that are available to 30 June. So please speak to Martin again if you need a bit of extra cash for your business. It's a great incentive available to help businesses. Single touch payroll, there are going to be updates. You have to report more items when you pay your employees, so make sure your systems are updated for that. And also there's going to be we're going to have to report annually any changes to our ABN details as an ABN holder. The only other thing, of course, we were discussing before, expecting interest rate rises. And again, we're in a bit of a higher inflation environment, so make sure you put those into your budgets going forward. So again, not only will you have no tax surprises, but other surprises that are going to impact your business's profitability.
Yeah. Did you want to talk briefly, Martin, to the loan scheme while we're here?
Yeah, look, I can. The SME loan guarantee scheme has only got about 23 days to run. Fortunately, some of the program can be accessed in about 7 days. And I've been very busy helping a lot of businesses access that, because not only is it a low interest rate, but it's also at a fixed interest rate, which is beginning to become more of an issue at the moment.
Yeah, it's attractive now. Yep.
Yeah, so it's quite attractive, and I think business is going to have a awkward year in the following year. So having a facility like the guarantee scheme provides gives you a liquidity backup for the bumpy road that may be ahead.
Fantastic. Thank you. Thanks for that, Martin. Should we get stuck into that checklist now, do you think?
Yeah.
Anything else that you wanted to cover before we do that?
Don't think so.
Okay, Ian, you good with that?
Yes.
So if I just go through it, because basically the way I saw this is these are questions that people should be talking to their accountants about.
That's right.
I think we've kind of covered off the first one, which is the average tax you and your close family members and your business entities shouldn't be paying more than an average rate of income tax at 30%. Now that's actually 25 now, you were saying.
Well, it depends really. It's between, it depends how much money you're making and how much money you need personally. But you shouldn't be paying any more than 30 at the moment. I would say 25 to 30. I don't know if you've got anything else. I've been modelling it recently for clients to see what it means with the new 25%. And I think it all depends. Most people, you could get it down to 25% on average.
Okay. What did you think on that one, Ian?
Yeah, no, look, I concurred. I just all I know is that when you apply the 5 basic principles of tax planning, which I've got on the notes, that's what you're trying to do. You're trying to just get the average tax rate down as far as you can, legitimately.
Okay, so the next two questions that we had on the checklist, I'm going to put them together. Are your business profits increasing or are your business profits decreasing? Now, I think we've already talked to that. Like if that looks really radical, they should be, or even just a little bit different, they really should be they should be talking to their accountant.
Oh,
Yeah.
well, if your business profits are decreasing, then what that means is that you can vary some of the pay as you go. If you've been paying pay as you go, you can vary that down. So so that's another reason to keep tabs on how you're going quarter by quarter, and then probably having a talk to your accountant at each quarter, because you can say, well, if the next PAYG is going to be 15 grand, say, right, but your profits are gone down, well, you may be able to get that down to 5 grand. So
yeah.
Right, that's
So-
part of your cash flow management.
So really talking to your accountant at least quarterly.
I think that'd be a great idea, even if it's a 1-minute phone call, just to say, what do you think? Do we need to discuss this further? You know?
Yeah, for sure.
The other thing is, I would say, with businesses' profits going down, it's more than just a tax issue. You've got to work out why they're going down and fix it quickly. So, yeah, because I think from what I've seen, after, working in big corporates, they're very adept at fixing things really quickly and reacting quickly to changes. And I'd love small businesses to all get into the habit of doing the same.
Yeah, that's a good point. So, because you see,
Yeah.
you've worked in a big corporate, which I think I know who that is, but that's because, it's because they have management processes in place, right? So a big corporate will have a monthly board meeting, and a big corporate will actually have actuals to budget, etc., etc. How are we going? They will have all that information at their fingertips. That's why they react quickly. Whereas what happens typically in small businesses, they don't have the capacity to actually have that management regime in place.
So it's really about checking everything at least once a month. So you make it so you can see exactly what's happening, where it's happening, and why.
Well, look, the starting point probably is at the beginning of each year, at the beginning of each financial year. This is typically what I would do. Is you do your final stuff for the 30th of June 22, say, all right, and then what happens is the first thing you ask the client, and you construct on almost out on the right-hand side of the figures that you're talking about for this year. Okay, what are these figures going to be for next year? All right, so right at that point in time, when you're doing last year's figures, you're actually getting an idea about how things are going to change. And then he will say, oh, well, look, or they will say, well, look, okay, that customer is gone. We're going to suffer a bit there because that one's gone. Or this one over here, the expenses are going up. Let's say they were using large amounts of gas, by way of example. All right, well, this one over here, our gas bill is going to double or treble or whatever it is. Right, so all those things you got in your head when you're going into the next financial year, and that gives you the opportunity to have a conversation with the client about, well, what do we need to do about this?
Yeah, because that's really creating your plan for the next year, isn't it? If you sort of take this year's figures and go, what's going to change in the ins and the outs, and then that also starts to give you a budget that you can measure against on a monthly basis.
That's right. And it's simple.
Yeah,
it's really simple. Just looking at the figures you're working on, you've finalised and saying, okay, what's going to happen with these figures for next year?
Yeah. And then if something changes, then you can go, why did that change?
Yep.
And you can build on the good things and deal with the bad things instantly instead of waiting till a small bad thing has become a catastrophe.
That's right. And depending on the business, each business is different, and some need to have KPIs that they monitor weekly.
Yeah.
Some, a lot monthly, some quarterly would be enough, depending on the business. They're all unique and have their own unique driving factors that can impact.
Yeah. And that's really understanding that what you really need to be measuring and how often you need to be measuring.
That's right.
And rather than just going, I'll deal with all this later. Yeah.
Not good. It's got to be now.
Absolutely. Yeah. And I really like that process, Ian, of taking last year's and putting them into next year's and then adjusting. Makes a lot of sense. Now, the next item we had here, I think we've probably already talked about this, was planning on selling capital assets or having a sale out of an item side of your ordinary business dealings. So have we talked to that enough, or is there anything else you wanted to say to that?
Look, only to say that, one of the, when you're talking about capital assets, selling capital assets, planning can be really critical about it. I mean, sometimes they're forced on you for whatever reason, but mostly when clients come to you and say, look, I am thinking about this or something else, okay? So there's two questions: how much and when? And so, you know, it's worthwhile doing that exercise. Because capital gains tax is really hard to avoid, but it can be reduced. It can be reduced if the taxpayer sells the asset in a time where their income is low and their marginal rate is low. And it's worthwhile sometimes, you know, thinking about that. You know, sometimes clients are in a situation where they can defer the sale of something. They mightn't have to get sold straight away. And of course, this is one of the big parts of tax planning, is just straight deferral. Right? There's there is no argument for bringing tax forward and paying it sooner rather than later. I mean, the only argument we've got in tax planning is deferral.
Some of the small business capital gains tax exemptions eliminate the need to pay capital gains tax at all, but you have to take them. They're only in specific circumstances, and your accountant would have to look at it on a case-by-case basis. So
again,
they're not available to everyone. Yeah.
So the next, and when we had planning on purchasing capital assets, which I think we've talked to, did you want to add anything? So again, it's about thinking forward and not just spontaneously going, oh, I think we'll get a new truck.
Yeah, well, look, the instant asset write-off is a good, like it's a strategy which brings a purchase forward, probably, and puts the money into the economy. But the other side of the coin is it actually deprives you of depreciation in the next year and the next year and the next year. So which means that if you go out and buy a new tractor and you get a tax deduction for it, right, you got to find tax deduction for something else next year. because what happened, all the government has done is change the timing of the tax take. Right, by giving you these incentives, all they've done is to defer their tax. So you're not going to pay as much tax this year, but next year, all other things being equal, you'll pay a lot more tax because you don't have that depreciation there.
Right. Yeah. Okay, got that. The next question we had here was about wanting to sell your business in the future. What are the implications of that, and when should we be thinking about that?
As soon as you can, because selling your business, it's more than just a tax issue. It's more about making sure that you can sell it for the best value possible. So there are so many things you should think about, you know, improving your systems and processes, looking at your management, cleaning up your accounts to take out personal items so that we've got normalised earnings in there. So it's all neat and tidy for a prospective owner to look at it. So it's about having that plan in place so that you can maximise the value. Also, of course, to minimise the tax in the way that you sell it. So think about what structure your business is operating in, and if the sale of that asset in that entity is the best way forward. Would a prospective, for example, if a prospective buyer wants to buy the shares of a company, or would they prefer just to buy the business assets? Well, a company you might want to move your business out of a company if that's the case, so that you can minimise the tax you pay on that sale, the capital gains tax. So I think if you're wanting to sell your business at any stage in the future, or even with succession planning, start the conversations as early as possible.
Absolutely, because the small business tax clauses regarding the selling of business and getting exemptions and all that kind of stuff, I have found them some of the most complex in the whole tax act. That might be hard to believe, but it is. It really, there's a couple I've come across where you've had, multiple partners, multiple families, etc., and trying to understand how they apply and trying to make sure that you can position yourself for their application is really, you've got to be really vigilant about it.
And at the moment, there are provisions in the Tax Act for small businesses. I believe, Ian, it's about if you've got an under $10 million turnover, you can restructure your business without paying capital gains tax. For example, move it from a company to a trust or a trust to a company, if that's a better vehicle for you, without incurring any capital gains tax. So I cannot emphasize enough the importance of having your business in the right business structure, whether that be a company or a trust, for its sale. It can greatly impact the capital gains tax you would have to pay when you sell it.
So once again, selling your business isn't something that you just go, oh, I'm going to put it on the market tomorrow kind of thing.
No, certainly not.
No, most businesses don't sell quickly. No. But you know, you need to have plans and a strategy. You need to make sure you maximize the value, minimize the tax for all the hard work you've put in.
Which is a long, from what you've been saying, it's a long plan. It's not something you just,
I believe if you want the best outcome, definitely.
Yeah.
But I like to plan for lots of different things, even if a company thinks they have to go into, for example, liquidation, or if they think, you don't like talking about it, but even if they have to go through a marriage breakup, for example, planning, see your accountant, talk it through.
Yeah, get professional, whatever it is you may want to do in the future, and the whole risk management thing as well there.
Yeah.
So actually having a plan in place that deals with risk as well as the goal.
Yeah.
Yeah, for sure. Okay, excellent. I know this is a good one, because I suspect there's lots of businesses that don't do this very well either. Are your accounts being prepared and updated regularly?
We were talking about that. I know some businesses only do it quarterly, and depending on the business, I love for them to get their bookkeeper to update them as regularly as they can, for the reasons we discussed, being able to react quickly.
Yeah, it's about being able to actually see where you're at, isn't it? Because if your books aren't up to date,
you don't know there are problems.
Looking at the left and the right and going, are we on budget or under or over budget? You can't see it if your books aren't up to date. So you're basically driving completely blind, like in the dark with no headlights.
Yeah,
like it is one of the. I was always a skeptic of the new tax system, because I thought that the government could have adopted a more Singaporean policy of saying, well, look, where we want to be, and in 20 years' time, like Lee Kuan Yew did in Singapore. And he chose the industries along those lines, what was going to be the flavour of the month in 20 years' time, as opposed to putting a GST in and saying, well, that's going to revolutionise our economy, which is effectively what John Howe did. But I have to give him credit for this, that the new tax system, with the quarterly BASs and whatnot, did at least force many small businesses to actually get their figures up to date, at least quarterly.
Yeah.
And so they did and do know roughly how they're going, at least quarterly. And whereas before, it was a treadmill right at the end of the year, obviously, with people saying, oh, how have I gone? You think, oh God, they're making decisions. Looking over your shoulder.
Yeah. And that's not a very good way to drive a car away from a raging bull.
Well, no, that's right. Well, the other thing is, of course, it's also changed the bookkeeping and accounting profession, because what's happened is that everybody now really has a compliance obligation to do their BASs. It was too expensive getting the accounting profession to do it, and so bookkeepers found a gap there and came in at a half, quarter, third the rates of what accountants are doing. And so, initially what it's done is it's actually butchered the income of accountants and given a hell of a kick along to bookkeepers.
I actually love my clients to have great bookkeepers, though, I've got to say.
Yeah, we're getting used to it. Yeah, we're getting used to it. Yeah, what we're doing doing a high level stuff.
And when I've got good relationships with bookkeepers, as I do, it's like being part of their advisory team. So they will come to me if there are things that they can see their clients need help with. So they're they're another person looking out for a good bookkeeper is looking out for the business owner in the same way. So
yeah, which probably leads to the next question, which was about being able to get the information you need to manage your business from the accounts you have, which really is just an extension of the question before. If your accounts are up to date and they're in a format that provides you that information, isn't it? So that's the key difference there. It's about what they look like and how you're able to read them. Do you want to talk to that a bit?
Yeah, it's still pretty pitiful. I reckon, is that the accountants basically still are looking mostly at tax, and that's what the whole benefit of the financial statement is. Look, just making tax decisions as opposed to financial management decisions. And what you'll find is a lot of accounts are prepared just to actually minimise the tax and to record that, rather than where are the profits being made, where are the losses being made, etc. Is that what you find? Is that what you find, Marie?
I don't think that's you and I, Ian, is it? But
no, we're not talking about us.
No, but I think everyone varies, and as you say, like, it depends on the business's needs. Some businesses might not need, if they've got a very astute business owner. Some private business have their own in-house management accountant. But yeah, a lot of accountants probably are too tax focused rather than looking at the whole picture. The need for good systems also, it's not just having your accounts done on time, but depending on the type of business, helping you analyse those results. So when you've got a very high sales volume, it might be worth getting a really good system that analyses that, so you always know the gross margin you're making on those sales, those products, which are the most profitable, which are selling the most, giving that greater depth of analysis on a regular basis.
Yes,
so
that's really important. Important.
So have you got adequate systems
Yeah.
to manage your business and analyse your business? So
yeah,
yes,
so it's not just go on here.
I've got a bloke who's got a health food shop, and his main focus is just measuring his margins, and everything that comes in, he knows what the margin is that he has to get in order to get the gross profit, to cover his overheads, to get in the profit. Right, and he is brutal on it. He is brutal. He's profitable.
Yeah. So it's not just a matter of having your accounts set up so you know what the numbers are. It's actually having systems that show you the fine detail of what you need to know to make informed business decisions.
Yeah, that's right.
Yeah. Okay, we're nearly at the end of the time, so we might just cover off the last two, which are pretty much about staff. So number 9 was about providing your staff with non-monetary benefits, and number 10 was about employing new staff or employing staff at all. So who wants to kick off with those?
I'll just say that, Ian, you can maybe do employing staff. There are lots of compliance measures that you have to be across when you employ staff, but when you give your staff non-monetary benefits, they're fringe benefits, so you pay fringe benefits tax. So talk to your accountant if you're thinking about providing them to your staff, because you can put yourself at risk of, a 47% fringe benefits tax rate, which is very high. So
yes, and look, I guess the big accounting firms are really into that stuff, because the competition for staff amongst the people that work for the big accounting firms is pretty fierce, and so there's all sorts of fringe benefits, I guess, are being conceived of. But we just have to be aware when the small businesses are competing with the big businesses, if we go and offer some of these fringe benefits, that there are implications. That's all there is.
yeah.
Which is part of tax planning.
Yeah.
Yeah, and that might not be something that a lot of small businesses would understand, that whole fringe the distinction between fringe benefits and.
Yeah. So it could be, giving them a bonus of a trip away, or, paying for a night out or a meal. It's all fringe benefits that you can pay fringe benefits tax on. It could be giving them discounted supplies from their business, discounted cars or discounted clothes from their retail business. That's a fringe benefit. So you've got to be careful about what you provide to your staff. Even loaning your staff money, that's a fringe benefit.
Right, there you go.
Yeah.
Okay, that was all the things that I had on the checklist. Martin, were there any questions in the chat or anything that you'd like to ask or add?
Well, I haven't got any questions in the chat because I think things have been very well covered. But I'm the one thing that I'm really taking away is that this is called tax planning, but it's really all about planning. Tax just is one of the issues.
Yeah.
I think people need to understand that small business is an exercise in planning, whether it's cash flow planning, tax planning, financial planning, and it's really just about planning. And I think many small businesses don't realise that it's not a business, it's an exercise in planning most of the time. Well, it is if it's going to be successful. So, and that's the recurring theme I saw mentioned here. Well, whether it be staff or whatever other issues or succession planning or selling, it's all about planning. So I think it's planning with a capital P and maybe tax with a small t.
I think there's a model that I really like that goes plan, act, review, improve. And that absolutely everything has to come into that.
And also it does put the gun to the head of the relationship with accountants. That there are many decisions that small businesses make that have tax implications and have other implications.
Yeah.
And it's not so bad. It's not so bad. I'm not trying to flog our service, but it's not so bad to have a good relationship with your accountant that you can ring them and talk to them about some of this stuff. There could be the payoff could be quite high.
Yeah. Yes. Rather than for those businesses who've got the accountant that they only talk to once a year when they send them the books and go, my tax return's overdue.
Yeah. That's right.
Yeah. Which is going to miss out on all of that wealth of knowledge that we just talked through that needs to be put in place as a plan, not left to the, absolutely. The Stop the Noise webinar series is brought to you by the Better Business for Good Strategic Partner Network, on a mission to ensure every small business owner has access to the knowledge, resources and support they need to succeed.